Welcome to our in-depth series on Benjamin Graham's The Intelligent Investor, the book that has been shaping the mindset of successful investors for over 70 years. Today, we are diving into Chapter 1, Investment versus Speculation, a foundational chapter that sets the stage for everything that follows. Whether you're new to investing or a seasoned market participant, this is one of the most important concepts you need to understand in order to succeed. Benjamin Graham, often hailed as the father of value investing, teaches us how to be smart, rational investors who can weather the ups and downs of the stock market. His approach to investing has influenced countless investors, including the legendary Warren Buffett. The key to Graham's philosophy is understanding that investing and speculating are not the same thing. These two approaches to the stock market differ significantly, and conflating the two can lead to financial ruin. So let's unpack what Graham means by investment and speculation. Investment, as Graham defines it, has three crucial components. 1. Thorough analysis. This means doing your homework, understanding the business behind the stock you're buying. You're not just buying a ticker symbol, you're buying part of a company. It requires a deep dive into the company's financial health, earnings potential, market position, and long-term prospects. 2. Protection of principal. The goal is to avoid losing your initial investment. This might seem obvious, but many people overlook this in favor of high-risk bets that could lead to significant losses. For Graham, protecting your principal is essential, especially when market conditions are uncertain or volatile. 3. Adequate return. The aim is to make a reasonable, sustainable profit over time. Graham isn't advocating for seeking sky-high returns or getting rich quick. Instead, he stresses that consistent, adequate returns are the key to building long-term wealth. By contrast, speculation lacks these fundamental safeguards. Speculation, according to Graham, is about buying an asset with the hope that its price will increase in the short term, without doing the necessary research into its true value. It's akin to gambling. Speculators are betting on market movements, often based on emotion, hype, or short-term trends, rather than solid research and analysis. Let's dive deeper into what Graham means by investment, starting with thorough analysis. Graham advises that investors should always start by understanding the intrinsic value of the asset they're purchasing. This involves looking at the company's earnings, its financial position, its competitive landscape, and its future growth potential. For example, if you're buying stock in a tech company, you'll want to know how the company's products are positioned in the market, what kind of revenue growth it's experiencing, and how strong its balance sheet is. By doing this deep dive into the company's fundamentals, you're far more likely to make a sound, informed investment decision. Thorough analysis is also about understanding the broader economic conditions. An intelligent investor considers how factors like interest rates, inflation, and global economic trends might affect their investment. Graham reminds us that markets don't exist in a vacuum. They're influenced by external forces that an investor must be aware of and take into account when making decisions. Next, let's talk about protecting your principal. For Graham, this is one of the most important aspects of being an intelligent investor. Protecting your initial investment means having a defensive mindset, not being swayed by speculative manias and focusing on preservation. Too often, investors become greedy when they see markets rising quickly, and they forget that the primary goal is to avoid significant losses. Graham's advice here is clear. Always consider the downside risk before thinking about the upside potential. If you lose your capital, even the best opportunities won't help you recover easily. Graham also introduces a critical concept here, the margin of safety. The margin of safety means buying assets at a significant discount to their intrinsic value. By doing this, you give yourself a buffer against market fluctuations. If you've bought a stock for $50, but its intrinsic value is $100, even if the market temporarily undervalues it, you have some protection. Graham's margin of safety is one of the most powerful tools an investor can use to avoid catastrophic losses. The third element of true investment is seeking an adequate return. Graham doesn't advocate for chasing extraordinary returns or getting rich quickly. In fact, he warns against it. He believes that steady, moderate returns compounded over time are the most reliable way to grow wealth. If you focus on avoiding unnecessary risk, your portfolio will eventually grow at a sustainable rate. The beauty of this approach is that it allows you to sleep peacefully at night, knowing that you aren't exposing yourself to undue risks in the pursuit of outsized gains. Now let's contrast this with speculation, which Graham describes as the antithesis of intelligent investing. Speculation is about buying and selling with the hope that prices will rise quickly, often without any understanding of the underlying value of the asset. Speculators are driven by emotion, by the fear of missing out, or the thrill of making a quick buck. They are more likely to follow market fads, rumors, or tips rather than doing the hard work of analyzing a company's fundamentals. A key characteristic of speculation is the absence of a margin of safety. Speculators often buy stocks at inflated prices, hoping that prices will continue to rise. But as history has shown time and again, market bubbles eventually burst. And when they do, speculators often find themselves holding worthless assets. Graham points to historical events like the 1929 stock market crash as prime examples of how speculative behavior can lead to financial ruin. Graham doesn't completely condemn speculation, but he urges investors to know when they are speculating. He argues that the biggest danger comes when people fool themselves into thinking they are investing, when in fact, they are speculating. This leads to overconfidence and risk-taking behavior that can be financially devastating. Graham's solution is simple. If you want to speculate, do it with a small, separate portion of your portfolio. Keep your speculative ventures separate from your core investments. That way, even if your speculations fail, your long-term investments remain intact. The dangers of speculation are further exacerbated by human psychology. Graham highlights that fear and greed are the two emotions that dominate speculative behavior. When markets are rising, greed takes over, and people throw caution to the wind in the pursuit of quick gains. When markets crash, fear causes them to panic sell, often locking in significant losses. An intelligent investor, on the other hand, remains calm in both bull and bear markets, sticking to a disciplined, value-oriented approach. In Chapter 1, Graham provides a clear roadmap for differentiating between investment and speculation. He emphasizes that investing is about making rational, research-based decisions that aim for the long term. Speculation, by contrast, is driven by emotion, short-term thinking, and the hope of getting lucky. As Graham warns, speculators may enjoy brief periods of success, but over the long run they are far more likely to lose money than to make it. One of the most important takeaways from Chapter 1 is that investment success isn't about being the smartest person in the room. It's about having the right mindset. Graham emphasizes that anyone can be an intelligent investor if they follow the right principles, focusing on value, doing thorough analysis, and being patient. You don't need to predict the market's next move to succeed. What you need is discipline, a clear strategy, and a long-term perspective. As we wrap up this expanded breakdown of Chapter 1, remember the key lesson from Graham. Be an investor, not a speculator. Invest with care, knowledge, and patience, and avoid the temptations of short-term speculation. Graham's principles may sound simple, but they require discipline and emotional control, especially in the face of market volatility. Thanks for joining us for this extended deep dive into Benjamin Graham's first chapter of The Intelligent Investor. We've only scratched the surface of what this investing classic has to offer. In the next video, we'll continue to explore Graham's strategies and how they can help you build a robust, risk-averse portfolio. Don't forget to hit the like button, subscribe, and turn on notifications so you won't miss out on future chapters.
Thank you for watching. Share this with friends and family, and please subscribe.